All right, let's dive in. Today, we are pulling back the curtain on the world of giant oil tankers, those massive ships that are, basically the lifeblood of our global economy. We're going to see how a major global crisis can flip a switch and turn these steel behemoths into a really high stakes financial game where fortunes are won and lost right on the high seas. So here's how we're going to break it all down. We're going to start with a super weird economic puzzle from back in 2020. Then we'll map out the global oil superhighway and see what happens when geopolitics throws a wrench in the works. From there, we'll unpack something called the floating storage play, figure out how to ride the industry's wild cyclical waves, and finally wrap it all up with some key takeaways on risk and reward. Okay, so first up is that economic puzzle. Our story really kicks off with this moment that just seemed to defy all logic, an anomaly that, believe it or not, holds the key to understanding this entire market. I mean, just think about that for a second. How is it even possible that you would have to pay someone to take a valuable thing like oil off your hands? It's kind of like a farmer showing up with a truck full of beautiful, ripe apples and having to pay you to take them. It makes no sense, right? Or does it? Yeah, this wasn't some thought experiment. This really happened. In April 2020, as the entire world was locking down, something just broke. The price of a futures contract for crude oil, which is just a promise to buy oil later for a set price, it didn't just drop. It crashed to negative $37 a barrel. Sellers were literally paying buyers $37 for every single barrel they would just agree to take. Wild. In this quote just perfectly sums up the physical reality of what was happening. It wasn't just numbers on a screen. It was a total logistical nightmare. The world stopped driving and flying, but the wells, they just kept on pumping. Every single storage tank, every pipeline, every refinery, it was all full, completely full. There was physically nowhere left to put the oil. And that gets us to the heart of the paradox. See, the oil itself wasn't worthless, of course not. But the immediate, desperate need for a place to put it created this bizarre situation where the cost of storage was just astronomical. You'd rather pay someone $37 to deal with a barrel than face the impossible and way more expensive task of storing it yourself. And this tells you the most important thing to know about the oil business. Logistics are everything. So that whole storage crisis really shines a spotlight on the system that moves all this oil around the planet. And to really get it, we need to explore the arena where all this drama plays out, the huge and surprisingly fragile global oil superhighway. The incredible efficiency of shipping is nothing new. It's been the backbone of global trade for centuries. Adam Smith was writing about it back in the 1700s, and that exact same idea, just amplified to a scale that's almost impossible to imagine, is what holds up our entire modern economy. And the scale today, it's just staggering. Get this, nearly a third, 31%, of all the crude oil that's shipped by sea passes through one single narrow strip of water. A single choke point on a massive map. But here's the catch. All that efficiency creates a massive vulnerability. These choke points, they're like the Achilles heel of the world's energy supply, and they often become ground zero for geopolitical crises. They are the catalyst for huge global disruptions. And this is it. The Strait of Hormuz. It's this tiny little ribbon of water that connects the oil fields of the Persian Gulf to the rest of the world. You're looking at arguably the most important shipping lane on the entire planet. Okay, just try to picture this. You have the world's biggest oil producers on one side and all their customers on the other. And they all depend on this one passage that at its narrowest point is just 33 kilometers wide. Every single day, a fifth of the entire world's oil supply sails through that tiny gap, not to mention a ton of natural gas. It's like a global economic funnel, and it is incredibly fragile. So what happens when a conflict flares up in this region? Well, everything just stops. Shipping companies halt their fleets, insurance providers pull their coverage. Suddenly, nobody is willing to risk a multi-million-dollar ship and its crew. The superhighway just grinds to a halt, creating this massive traffic jam of tankers and sparking an immediate global supply shock. The effect is instantaneous, and it's massive. Yeah, there are some pipelines that can bypass the strait, but they can't handle nearly enough volume. Analysts figure a full closure would rip somewhere between 8 and 10 million barrels of oil per day right out of the market. That's almost 10% of the world's supply, just gone overnight. And this sudden shutdown brings us right back to what original problem: storage.
The consequence of a disruption like this is what the industry calls the floating storage play. And this is where the real financial action starts.
So, let's just walk through the chain reaction. A crisis erupts at a choke point. Oil can't get out, so the storage tanks on land fill up, fast. The only option left? The tankers themselves. They stop being transportation and they become floating warehouses. Suddenly, the demand for any available ship just skyrockets. And the daily lease prices, they're called spot rates, they don't just go up a little bit, they explode.
And look, this isn't just theory. This is the playbook for how people try to profit from chaos. The second a choke point is threatened, the market reacts instantly. Tanker prices jump as countries and traders scramble to get their hands on ships, not just to move oil, but crucially, to store it. Honestly, the best way to think about it is like Uber surge pricing. Imagine a massive concert ends and it starts pouring rain. Everybody wants a ride at the exact same moment, and the prices just go through the roof. The tanker market is exactly the same, just on a global scale. A crisis creates this absolute desperate demand for a limited number of ships, and the price to hire one can jump 5, 10, even 20 times higher in a matter of days. Okay, let's zoom out for a second. This whole floating storage play is a really dramatic event, but it's actually part of a much bigger pattern. To really understand this market, you have to get your head around the intense, repeating cycle of boom and bust that defines this entire industry. The tanker business is like the textbook definition of cyclical. It's not like a company that sells toothpaste, where demand is always pretty steady. A tanker company's profits are totally tied to these huge swings in the global economy and geopolitics. And the cycle is all about a supply of ships that's slow to change, because it takes years to build a new one, and a demand for them that can change overnight. In the good times, profits are insane. But in the bad times, when there are too many ships and not enough cargo, these companies can lose money for years on end. So you get this crazy emotional and financial pendulum that just swings back and forth. It all starts with pessimism and fear. After a long slump, companies are going bankrupt. Old ships are being sold for scrap. No one is building new ones, and investors won't touch the sector. Then, some catalyst hits. A war, a supply shock, rates spike, and all of a sudden, it's all optimism and greed. Profits soar, stock prices go vertical. But that greed eventually leads to everyone ordering new ships. The crisis passes, and fear comes back, sending prices crashing down and starting the whole cycle over again. Warren Buffett's famous quote is the perfect guide for this. The real opportunity in these businesses is often to buy when everyone else is terrified, and the industry looks like it's dead. That's the bottom of the cycle. By the time the good news is on the front page and everyone is piling in because of greed, the smart money is often already heading for the exits. Okay, let's pull all these threads together now. We've seen the paradox, the arena, the catalyst, and the cycle. So now it's time to put it all together into a clear-eyed view of the real risks and rewards here. But before we sum up, we have to talk about risk the right way. A lot of people think volatility, those big price swings, is risk. But Buffett's definition is much more helpful. Risk is the chance you lose your money for good. In the tanker industry, the prices are going to swing wildly. That's just a fact. The real risk isn't the swing itself. It's buying at the absolute peak of the cycle at a price so high that you might never get your money back. So here are the main things to take away. 1. Marine shipping is the circulatory system of the world economy. 2. Those geopolitical choke points are its biggest weakness, and they create these insane imbalances. 3. These crises kick off the floating storage play, which sends tanker rates into the stratosphere. 4. This whole setup makes the industry super cyclical. And finally, number 5, being successful here isn't about predicting the next war, it's about understanding where you are in that big boom and bust cycle. And all of that leaves us with one last big question. We've talked a lot about the Strait of Hormuz, which has been a hotspot for decades. But the world is always changing. As trade routes shift, as new energy sources come online, and as political alliances get redrawn, the map of what's critical is also changing. The ideas we've talked about today, well, that's your toolkit for spotting and understanding the next choke point, wherever and whenever it shows up.